Awesome. So I've got 6:01, so let's get started. First of all, welcome everybody. This is kind of fun. I have never done a webinar with Dave Spano. If you listen to my show, which is every Monday through Friday, 8:30 to noon on WTMJ, Dave joins me on Mondays along with Carol Kane. And I've learned a lot from him. He's a guy that's so well respected when it comes to investing and making those critical decisions that a lot of us have to make as we approach retirement. So you can hear him, of course, Mondays at 10:35. That's a selfish self-promotion. But of course, the great chance to listen to his wisdom is on Saturdays at 10 o'clock. He's one of the hosts of Money Talk along with Mark Oswald at 10 a.m. on Saturday mornings. Amazing show. I always tell Dave I'm often doing yard work with the headphones on or got my Milwaukee Tools radio out there listening to their wisdom. And I've learned so much on the show. We're hoping that tonight you can also learn from Dave. He's got a short presentation. There's an opportunity at the end to kind of ask questions. A couple asked from me. Make sure you mute yourself before Dave starts his presentation. If you have a question during the presentation, just put it up on the chat screen. Kristen will get your name and your question, and she'll call on you in the Q&A portion, and we'll kind of get started. We're all about trying to give you answers, and Dave is probably the best resource for that in investing after the pandemic or post-pandemic, the decisions you have to make. And I guess I'll start with this, Dave Spano, as I introduce you. This is an interesting time. We had the lowest of lows last, March, April, and then, boy, just the market took off. Lots of people maybe took their money out unwisely or wisely, depending on where they were at. And now we have decisions to make going forward. So I'll let you take it from there.
Yeah, it's a great start. You know, we put a piece together, which was, if you look at this, it's a discarded mask, right? Sitting on the sidewalk, which is just a pet peeve for me, but there's a little green shoot popping out, right? So I think that's a really good sign of where we're at. And if we can go to the next slide, we have a disclaimer that the Securities and Exchange Commission wants us and makes us put out there. And of course, it's a disclaimer that says these are discussions in general. These are not recommendations to any one individual. Your individual needs are based on your own facts and circumstances. Lawyers, check mark. All right, next slide, please. So really, to your question, you're right on the money as usual. This is the S&P chart over the last several years, and you can see the general trajectory is up and to the right, and it's been that way for a long time. You can see in 2019, I don't have a pointer, but you can see that first V in the end of 2019. That was in late 2018. That is really what we call the taper tantrum, and that was the fact that the Federal Reserve was suggesting that they were going to raise rates, and the market reacted violently there. So that's an important point. I'm going to come back to that. Let's fast forward to March of 2020, and Steve, you asked me a lot about what happened here and what's going on. Well, we all know this is not new news. This is just a retracement of where we are, and it's important though. Why did the market fall apart the way it did? Is because we shut the economy down and we had no idea to the depth of what was going to happen. So the S&P, which is, I like to use the S&P, Steve, more than I like to use the Dow. The Dow Jones is 30 stocks, and it's general industrials for the most part. But the Standard & Poor's 500, or the S&P 500, is the 500 largest capitalized companies that are available to purchase on a public market. So it's just a broader description. Well, you can see what happened. It went from approximately 3,200 on the S&P all the way down to 2,300, and that's what happened. And then we talked about what happens going forward. And you and I did an interview approximately April of last year, almost a year ago. And we said, what happens? And I said, stick with your plan. We're going to have a recovery. We're not sure if it's going to be a V recovery, a square root recovery, or a W. So up and then back down and up was the W. The square root, you'll see, would be right back to where we were and then flatten out. And we suggested we could see a V recovery. And that's what we have here. And that V that you see in March of 2020 is obvious right there. And again, this is just a retracement of the facts that we already know. What's
and
important,
Dave, just real quickly, people always want to know why do you think it's done so well since? What's driving that incredible spike?
yeah, and it is everything that we're going to talk about today, and that is what's been done. And most notably, what's been done is fiscal and monetary stimulus like we've never seen before. That's the answer. And then we're going to talk about why the S&P has done better when the economy really hasn't done that well yet. All right. And so this spike up, what I want to point out is we closed today at 39.80, somewhere around there. I mean, just at the doorstep of 4,000 on the S&P 500, an all-time high. And we still haven't reopened the economy yet. So that's going to set up the conversation of where we go. If we can go to the next slide. This is something different. This is the US GDP, or gross domestic product. It's a measurement of the economy. Again, different from the S&P 500. What you'll see there is more of the square root, right? You can see the trend line, the yellow dotted line. Then you'll see the white line, which is the crash of the GDP. In the yellow box, you see what happened. You see first quarter, we were down 5%, which is a bad number. Second quarter, a number like we've never seen before, 31% down on GDP. But that's when we talked about that we're going to have a recovery. 33% is a number we've never seen for a quarterly recovery in the third quarter. And in the fourth quarter, 4%. So that gap between the yellow dotted line and where we are today is what we call we're going to have a reversion to the mean. What does that mean? It's going to get back to normal. And so at some point, the GDP is going to continue to grow until it gets back to the normal line. And that's what we're showing. So we talked about the S&P 500. This is GDP. The expectation for GDP for this year is 6%. We'll all remember, and that's not a political statement, but starting from the great financial crisis, which was really when Bush 2 was in, and then we had Obama, and then we had Trump. We had never had big GDP numbers. Our expectation for GDP for this year is between 5 and 6%, and for 2022 is nearly 4%. Great GDP numbers. And remember, and I'm sure everyone on this call knows that negative GDP, back-to-back quarters of negative GDP, is the definition of a recession. Well, right now we are showing expectations of high GDP, so significant higher GDP through 21 and 22. Next slide, please. Now, long answer to your first question, Steve. There's three different charts here. The first one is the GDP of the country. What you can see, that top box on the farthest one to the left shows that 29% of the GDP in this country is government spending and farm, agriculture. 29%. Move one slide over, you can see government and agriculture represent 36% of the employment, but third slide, third bar, not represented in the S&P 500. You can't buy a government stock and you can't buy a publicly traded farm. Let's go back to the left-hand side. Again, the bottom portion of GDP, technology is on the bottom. And if I'm moving too fast, everyone just put a chat out there or let me know. The bottom one, back to the left-hand side, GDP by technology, just 6% of the GDP of this country. The middle bar, just 2% of employment. And I'm sure everyone looked ahead. The third bar, 38% of S&P 500. That's the big story right there. So those bottom three, technology at 38, healthcare at 13, financial services at 13, those three represent 2/3 of the S&P 500. And that, Steve, you'll recall, we had that conversation in April, in May, in June, and said it's a head scratcher. Why we know that the economy is just being dragged down. Those three segments, financial services, healthcare, and technology are 2/3 in the S&P 500, and they stayed open.
Dave, do you think people look at the Dow more than they should and not pay enough attention to the S&P?
It's not that it's bad. I mean, it's been around, for so long. I mean, if you want to go back historically, you can see that the Dow Jones has been of average number. And if you look at, Steve, really the trajectory of the Dow Jones and the S&P 500, they're not materially changed. It's just we like to look at it because of the 11 sectors that are there. It's just a broader perspective. And sometimes in the short term, you'll see the Dow doing better than the S&P 500. And it's because a particular stock, like Boeing, for example, that can move the Dow Jones significantly in any one day. And then the second really big point between the Dow Jones and the S&P 500, the Dow Jones is price weighted. What does that mean? So a stock that's $300 or $400 has a whole lot more impact on the Dow Jones index than a stock that's $30. That $30 stock could be 10 times the $300 stock in capitalization. So it's just say, think about Apple. Apple's $120, right? But that is the largest company. You can find a company that's trading at $500, but it's a much smaller company. So we don't like price weighted. We like a more impactful index. But this is the answer to that question that you asked me 10 minutes ago. Is the breakdown of the S&P is technology, healthcare, and financial services represent 2/3 of it. Okay? All right, moving on. I'm trying to move fast, Kristen, so we can get to some questions. All right, answer to why did we move? The Fed balance sheet. What is the Fed balance sheet? And I don't mean to make this in economics class, but we all heard about the Fed balance sheet is expanding, right? So Steve, I think we all know what that means, right? Maybe not.
Yeah.
So Fed balance sheet is the Federal Reserve has two jobs. It's often called a dual mandate, two jobs. One is price stability. In other words, to keep inflation under check. We remember Carter, 79, 80, 81, when inflation was double digits and money markets were double digits. That's one, is control inflation. The second is full employment. So they want to make sure that the economy is growing, unemployment is getting better. You'll recall before the pandemic, unemployment was in the threes, a number that is just historically fantastic across all segments. And now we spiked up, but it's getting better. But the Fed balance sheet, they can do things to control interest rates and jobs. One of those is to go and buy debt. Go out into the open market and buy treasury bonds, buy high yield bonds if they wanted to, buy corporate bonds, buy municipal bonds. And then just like anyone, like a house, you have assets and liabilities. Their assets are beginning to increase. That's what this big spike is, because they're buying all kinds of debt. When they are the biggest bully in the room, to use that expression, if they are buying a lot of one particular product, they're pushing the rates down. Bond prices go up, rates go down. Rates go in an inverse direction. So they are buying all kinds of bonds. That keeps interest rates low.
Did you support that policy at that time? I'm looking here. It's around the fall of last year. That was the right time to be moving that money around?
Well, because we didn't know. Based on the facts and circumstances at that time, we didn't know. I mean, we all were told that, 100 million people were going to perish from the disease, and we just didn't know. As we knew more, I think they can begin to change their policies. The problem is, we'll get to the next slide. The reason why it's an issue, if you go to the next slide, Kirsten, is you'll see what's happening. You've got Fed balance sheet, you have debt. The debt held by the federal government is now 30 trillion with a T, 30 trillion, right on the doorstep of that. This slide goes back to 2005, when it was about 3, 4, 5 trillion. You can see it's gone up. Now remember, this is the history of the country. Since World War II and beyond, we had $4 to $5 trillion of debt. And just in 15 years, it has grown to a substantial amount of debt. And why is that a concern? If you go to the next slide, is because if you look to a percentage of GDP, where we are today on the farthest right-hand side, you can see it's 100 to 120% of GDP. Well, how does that compare, right? It compared to what? You have to go back to World War II to see the kind of debt that we're taking on in this country. You know, back when we had war bonds and, you know, everyone had to go to work in the factories to keep the country going. That's where we are with public debt. And the reason why that is a concern is because it has an impact on interest rates. Moving along to the next slide, you'll see that the second thing that is happening, you've got public debt, answer to your question. The second thing is stimulus. All right, so you have monetary policy and fiscal policy. That's this part. If you compare the amount of money that has gone out, trillions with a T, right? 1,000 billion, a trillion is 1,000 billions. $6.1 trillion has been put to work in the last 12 months, 6.1 trillion. And President Biden suggested another 2 to 2.5 today. And we'll get to that. By comparison, Steve, 1.8 trillion was in the Great Recession back in 07, 08, when there was this cascading failure of financial institutions. We'd go to the studio on Saturday mornings, and one of the things I would get, because they didn't release until Friday after the close, was the number of bank failures. And on Saturday mornings back in 06, 07, 08, 09, I would talk about the bank failures, and that was a big deal. That was a scary, scary time, right? And you can see it's 3 times the amount of stimulus that's happened in the last 12 months versus the Great Recession. Why is that important? Because this is a big part of why the economy is, or the stocks are going up, is because the amount of stimulus that's being injected into the economy. And remember, when this stimulus comes out, has a delaying factor. In other words, you can say it's released today, this $1,400, for example, but it may not be injected into the economy by the recipients months, maybe even a year from now. So there's a trailing factor that could happen, and that's one of the reasons why you're going to see GDP have this sugar high at least for another 6 to 9 months.
And Dave, real quick, there's even some conversation among, I think at least 60 members of Congress, that there should be another round of stimulus payments at some point. In your opinion, professional opinion, there can be too much of this.
There's no question it can be too much. And my personal opinion was it had to be more targeted. You know, if you look at the amount of people that got checks, 85% of Americans who filed taxes got stimulus check, 85%. But I would argue that 85% of Americans didn't need the check. I'm not opposed to the people who need it getting support, not at all, right? But was it 85%, and did it have to go to those folks? If you look at, Steve, where it was, how it was used, a third of those people saved it in last time and are likely or hired to save it this time. So that doesn't have an immediate effect on GDP or growth. 60% of them spent it, paid back rent, groceries, whatever they had to do. That's what it was for. And there's a number of people though who are sitting on it. So it could be rocket fuel down the road. So will we need more? There's some economists who are saying that some folks are becoming dependent upon it. And so that's hurting the employment numbers. Okay. Mm-hmm. Moving through, and I'll bring all these pieces together, everyone who's listening. Next slide, please. Brings us to, what's been distributed, $400 billion to consumers in March. And you can see sometimes there's a delaying effect of that. And you can see a spike, and then the next month, and then it trails off. So we expect that you're going to get another one of these spikes in April and May. And I think the conversation the next time through is, do we need another stimulus? Will be met with a whole lot more resistance than this last one was. Next slide. All right, so having said all of that, and your question is right on, Steve, is will we see more? Well, we saw more of it today. Now, I put this slide together with the help of a group that we use out of New York, in Washington, D.C. So we had this together yesterday. We were pretty darn close to what he came out with today. He came out with $2 trillion. Package one is what our friends in DC are telling us, and that there's a second package coming down the road, right? Package one is, we'll call it 1.9 trillion. I think he said President Biden said 2 trillion today, but infrastructure would be a little less than half of that. Climate, future spending down the road, housing, schools, and broadband. I think you can make an argument that if you've ever flown to New York and been through LaGuardia, that infrastructure's needed. You look and it looks like that damn place is going to fall down. We know the bridges need attention. We certainly know that people outside of urban areas don't have access to broadband. So there are parts of this that you're going to get bipartisan support for, right? And I think that's the first part of it. And the second part is more of the social spending, which is the reason why I think he pulled it out and is going to come back for a second bite at the apple. For another 1.6 trillion or to get to 3.5 trillion, paid leave, child care credits, child credit, paid community colleges, Obamacare credits and the like will probably be at the second bite at the apple. And there, the conversation will likely turn to income tax increases on individuals.
And I think that's a smart play, because if you look at that top group, those are things that the previous administration even supported: infrastructure, some of the broadband stuff, and obviously climate probably wouldn't be in there, but the school funding as well. So there are things that I think you're right. You're exactly right. This has bipartisan support. The other stuff, that in my opinion should be separate.
Yeah, and think about it, and let's go back to President Obama, who said shovel ready, right? I had friends in the Department of Transportation who said, shovel ready? Are you kidding me? You know what it takes to build a freeway? First of all, the vetting and the engineering and, the moving of the traffic and in telling people to avoid roads. It's years and years and years. There was nothing that was shovel ready. But so even if we say, yep, we're going to do this and it gets approval, this 1.9 trillion could be spent over 10 years or maybe longer. Right. So next screen, and then we'll see if we can open up the questions. So how is this going to get paid for? There's two ways that you pay for this type of thing. Number one is debt that we talked about. The second is revenue. Here are revenue ideas to pay for it. The first one we were right on the first one and the second one. 28% corporate tax. It used to be 35%. Trump lowered it to 21%. 28% is what was floated today. We expect that it's going to go up somewhere between its current position of 21 and 28%, which is the proposed position. Expect 25, 26 likely as a digestible number for corporations. GILTI is a funny name, but it really talks about incomes that is derived overseas. Is that it would force companies that derive revenue overseas to pay United States income taxes. And then the rest of that stuff hasn't come out yet. We think it's tied to the next package, but income taxes going up to the repeal of the Trump tax cuts, income tax deductions, so putting back what's called the piece. But in that you might get the SALT taxes. If you guys remember what that was the people could deduct property taxes, which led, when they pulled that away, that led to the high tax states having an exodus. California, folks went to Arizona, people in New York, they went to Florida, and we have an office down there, and I can assure you that is exactly what's happening. We get to talk to a lot of folks down there, and they left because of the high tax rate. So if SALT comes back in, I think it's highly likely SALT, or deduction of property taxes, gets put back in. Next slide. All right, third part. So we talked about, what's happening on the fiscal, what's happening on monetary stimulus. Here's another situation which is pushing things along: herd immunity. Now this report, we believe, got from the CDC, right? It's from Statigas, but it says that the blue line said between people that have been infected And docs are telling us 4 to 6 to 8 months of some type of that'll hold you off. And then you have vaccinations, and that crosses over in somewhere around June or July. And you'll remember that President Biden said by July 4th, you'll be able to go in your backyard. Can't tell people down in Florida, I can assure you that, because in other places, Texas. But herd immunity somewhere in the summer means that the economy is going to kick back in. And remember, there is a lot of pent-up demand. People who have been stuck at home will want to spend that money. All right, moving on. We're reopening. I talked a little bit about Florida and Texas, and then the ones on the bottom, ones that aren't closed are staying more closed. California, parts of Chicago, Hawaii. By the way, you might have saw this afternoon that President Macron in France is going back to a lockdown, shutting down schools and not letting people travel. So they're having another spike in Europe that is causing the CDC some concern here in the United States. Next slide. And I'm getting to the end, folks. Okay, so what does this all mean? It means that economic activity always goes in these cycles, early to mid to late to a recession. Now, if you start on the right-hand side, we are coming out of a recession. We're out of the recession. So now we're in early. We're back to the beginning of the cycle. If you look at where we are, we're the green button. We're behind China, but we're green, which means that we are moving from early to mid in the cycle. So what does that mean? That growth will continue for some time, that profits continue to get up, and then they begin to peak. And then as you move into a late cycle, it could be a year or so, or 3, then you go to late cycle, and then you can start to see the decline in the recession. And we saw this. We started to talk about it in about a year and a half ago, that we were in late cycle. We mentioned a lot on the show that we were in late cycle. Now, nobody knew that what was going to happen with the virus, but we certainly said there could be some event, be it geopolitical or other, that we don't know about that could push us in a recession when you're in late cycle. But here we are, early to mid cycle. The markets are proving that at all-time highs on the S&P 500. 2 more slides. In early, what does well? You can tell U.S. stocks do really, really well. Investment grade bonds do okay, and cash is cash, right? Then you get to mid-cycle, stocks do okay, better than normal, but just okay. Investment grade, so your total portfolio begins to decline. Late cycle stocks struggle to make a profit, and then in recession you have negative. And that's the reason why we pay so much attention to recession and GDP numbers, because recessions are tied to bear markets. Bear markets are 20% pullbacks. Next slide. And that, by the way, that's over the last 70, 80 years. This is equity versus bonds. Equities do a whole lot better. So this says bond fund sticker shock. That means bonds haven't done well. Why? Because interest rates have gone up. When interest rates go up, bond prices go down. So when people get their reports, in a couple of weeks, I know there's some of our clients are on here, the fixed income did not do as well. And that's because interest rates went up. I think we did a really good job of controlling that. And you can do that by, you think about a bond. A bond is not a stock. Its job is to stabilize. Its job is to diversify. That's why it's there, and get you a little bit more return than cash. And so you can control that by buying different kind of bonds. Bonds that have credit, right? So a treasury is the highest credit on a high yield bond, often called a junk bond, is lower credit. You can buying different type of credits you can control in duration. The shorter the bond, the less fluctuation. The longer the bond, the more the fluctuation. So controlling credit and duration can control your bond fund return. And lastly, or second from last, this is called the gray rotation, and we've been talking about it. What does this chart mean? All right, the first is years. The second is domestic equity. What that shows is money has been coming out of domestic equity mutual funds for 12 years in a row. It's gone, some of it has gone to exchange traded funds because they're less expensive. Some of it has gone to international equities, but that yellow box that I highlighted there on the bottom, if you take the domestic equities that came out of mutual funds and balance it off with what was gained by going to exchange traded funds, international equities, it's neutral. Compared to bonds, people continue to pile in fixed income. So at some point, we talked about a reversion to the mean. At some point, bonds are probably going to get sold off and money is going to get put back in stocks. So this is a really, really important part of this whole presentation, which is the reason why I put it second from last. Is the great rotation just beginning? If interest rates continue to go up because of all of the stimulus and inflation goes up, there will be a rotation from bonds to stocks, which is more pressure on buying pressure on domestic equities, particularly.
When I saw the slide this afternoon, I did some reading on the great rotation. There's a lot of thought that this market could really be strong going forward in the short term. In long term, you never really know, but boy, there could really be a push to a strong bull market.
Yep, for sure. Now, there's a concern that you could get overbought, right? And we're probably getting close to that. All right, the next one is the last slide, Kirsten. Thank you. So what does this mean in general? This is the whole deal. There's stocks and there's bonds. There's 60, there's 40, there's 70, there's 30, wherever you're at. Is gradually move to overweight position in equities, diversify between large, mid, small cap, and international. And remember that there's these trends that are changing, which is, you think about just trends. Someone recently gave me a book of the trends in this country, and just, think about healthcare. Think about, my dad was a World War II vet, and what he went through in his life and what we get to go through in ours are substantially different. So there's no question that secular trends will continue. Technology and healthcare. There's a demographic shift. You think about what happened and where we were in Vietnam in the 60s and early 70s, and where it is now as an economy. And then this winner take all phenomenon is probably going to change, which is the large caps, which are the 5 big FANG companies, which are not tremendously popular right now with a large chunk of people on both sides of the aisle. You think about the Facebooks and the Twitters and getting called in front of Congress to get scolded. So this whole large cap thing, there may be a change there, but equities diversified makes sense. On fixed income, be very careful of what you're doing in the fixed income side. If you need help understanding this is what we do. It's not a sales pitch. It's an opportunity for people to understand what's happening and bring this all together. And then last slide is, if you need any help, we can give you a portfolio review of the assets that you own. We do this on a daily basis across our 8 branches. Our team gets it, gives you a report, sends it back to you, as well as a framework for a financial plan. There are no strings attached to that. We do it a lot. What we do find is some people engage us and some people do not, but it's an opportunity to walk away with something that's tangible.
And I think I've asked you this question before a couple of times throughout the year or so that you've been on the show, is how often should you be reevaluating or kind of looking at where your investments are at? Is there a proper timeline, or is it just kind of evaluating how you feel about your investments?
Well, we think that you should, look at it every quarter, certainly not every day, but there people have access to information between websites and apps and CNBC and so on. You can overdo it. There's no question. And Buffett famously said, if it bothers you to watch your stocks go up and down every day, then don't look at them. Right. So that's his advice. But, if you every quarter, and the reason why is because facts change, circumstances change, and the scenario changes. So, something that made sense in February of 2020 did not make sense in May of 2020. Right. And so the story changes if there's a dramatic change in Fed policy and interest rates in policy. You can see change in policy all over the place. That is going to change how you allocate your capital and where you should allocate it.
Kirsten, we can take some questions if you had some that were submitted.
Great. Yeah, I don't see any in the chat yet, but if anybody has any, feel free to raise your hand, type them in there, and we can get your questions answered.
So
Well,
for those who are technology challenged, should we tell them how to chat?
Yeah, there, if you go towards the bottom of your screen, you see the mute, start video, security, participants, and chat, kind of right in the middle. So feel free to click on that and it'll pop up over on the right-hand side and you can type in your questions there.
All right, as we're waiting for that, Steve, you know, there's, you know, I really appreciate the time that we get to spend on a weekly basis, but in preparing for this, you had a number of questions, and one of those was, you know, people aren't spending the stimulus checks, right? And some of them are, you know, a percentage of them are saving that. But what we're seeing is that could turn into, as I said earlier, rocket fuel. In other words, you're going to have a transition from what happened now, that we're going to get that money put back in the economy 6 and 9 months. But listen, as a financial planner for 35 years, when people save more, it certainly makes our job easier, because when they come to us and they don't have a ton of debt and they have more assets to replace their paycheck, those are really good things.
I see a bunch coming in, Kirsten. So if we can get that, just say the name, we'll have them unmute their mic.
Yep, it looks like Ty, he has a question. Ty, if you want to unmute your mic and ask. Ty, are you there? Well, Ty chatted, he asked Russell or S&P?
Okay, so the Russell 3000 is the smaller cap companies, and the S&P 500 are large cap companies. We're clearly seeing a switch to this as you move through the cycles. You know, what happens first is big companies then sell their stuff, and they buy stuff from mid-cap companies. Think about General Motors. And while there might be a company locally who's a welder who makes a bolt for the Corvette, whatever, right? And so mid-cap companies begin to transition, and some of those mid-cap companies are underpriced by price to earnings ratio. So Ty, I don't think it's a binary decision, one or the other. I certainly think that beginning to overweight Russell 3000 is a good spot because it just had a correction.
Great, thanks.
I see Randy's got a question.
Yep.
Go ahead.
Yes, I see the market has done fairly well considering we're going through a pandemic. A lot of that has to do with the government and what the money that they're giving to everyone. I'm wondering if that will cause a correction in the market in the near future. The next couple of years.
Yeah, good question, Randy. Thanks. And so, does the stimulus money cause a correction? Well, what it does do in the short term, Randy, is it pushes money out to individuals, and then they begin to spend it. And in our economy, 70% of GDP is measured by consumer spending. So in the short term, it's a sugar high, and it raises GDP. So there is a benefit in the short term. It's an offset, of course, by how you got that money out there. Did you borrow the money to put it out there? Did you raise revenues and take it away from profitability of companies to put it out there? What's the offsetting effect? But there's no question that in the short term, it raises GDP. And you think about individual names, if people all run out and go to Target or Walmart or go and buy a new car, those companies are going to sell more stuff, which means their net income is going to go up, which means their stock price should go up.
Looks like Nate K has a question, so if we can have him unmute his mic and ask the question.
Hi. Yeah, my question is, you know, we're taking on all this debt. When do we expect this to adversely affect the market? And I know the markets usually lead the economy. So more, what's the thing that we should be looking at other than stock prices going down to get a jump on, you know, before the prices start going down?
Right. So So stock prices in the economy are and we had a slide on that, are sometimes disconnected. So if you think about a stock price, whatever it is, let's just think about, and I get to see Target from where I sit, but if Target sells more stuff, they sell whatever it is, and they now have $1,000 of revenue, right? And then they take their expenses out of that, $90 or $900. There's $100 left. That's their net income. That's their profit. And if you put that in share price, let's just say that's $2 a share. Well, if it's $2 a share, I know a 10 PE, a 10 multiple means that's a $20 stock. If it's $15, if it's 15 times or 15 PE, $2 times 15, that's a $30 stock. If, Nate, there is more people spending and companies' profitability goes up, the stock market is going to reward those companies with either higher multiples or expectation of higher sales and earnings. So you have to disconnect sometimes what's happening with GDP and debt in this country, what's happening to stock prices. Now, there can be an event, like just imagine a bad event. Let's imagine either a geopolitical attack or somebody from the Federal Reserve saying that we can't afford all this debt, some crazy thing like that. That would certainly affect stock prices in a big way. But right now, we're seeing every single downturn, every single correction is being purchased because if you think about the Great Rotation, all of that money is looking for a home, and 2% treasuries or 1.7% treasuries is just not getting it done. It's not getting the job done. And so therefore, we think that this rotation is going to continue, but you got to be careful on where you invest it. And maybe it's overseas. Maybe it's small caps. Maybe it's not always buying big tech, large cap tech companies.
Are you saying then to watch PEs?
You have to watch PEs.
They're elevated right now.
They certainly are. They're higher than normal. Normal price to earnings ratio is generally around 16. We're trading about 20 to 21. The argument, when I've asked the same question to people smarter than I, they say that PE ratio is based on a historical rate of return, a historical interest rate of 4 to 5%, right? Today we're at 1 to 2% because they're lower interest rates. That allows people to pay more for stocks. And there's a formula to do that, but it's really lower interest rates allow higher prices, and that's a higher PE ratio. So you have to take the 21 PE ratio compared to an average of 16 and discount it just a little bit because of historically low interest rates.
Looks like Laura has a question, so go ahead and unmute your mic, Laura.
Hi, Dave and Steve. How are you?
Good.
Thank you.
Question, what is your opinion in investing in whole life insurance policies and using the growth in cash surrender value as an alternative to a portion of a fixed income portfolio?
Yeah, so I think you nailed it right at the end, is as a portion. Now, for those rest of everybody else on the call, so there are, you can buy life insurance. Just buy the insurance, that's called term. You can buy life insurance and have some type of accumulation account, and that is either whole life or universal life. In our town, we have one of the best whole life companies in the country, Northwestern Mutual, and they have a high interest rate that they pay. And so as a portion of fixed income, I am not opposed to people using a small portion of that in lieu of fixed income because of the higher interest rate that Mr. Schlifsky and his co-folks can continue to put out there. However, you have to remember there's a cost to everything, and there's a cost to buy the insurance. And so you better have an insurable need and reason why you have the life insurance, otherwise it doesn't make sense. But if you have an insurable need, you have kids, you have a mortgage, whatever the insurable need is, and you say, I'm going to take a portion of this, whole life insurance companies like Northwestern make sense. Not everybody falls in that category. There's some kind of crappy insurance companies out there. They're not one of them.
Thanks for the question, Laura. Dennis has a question on taxes and his 401k.
Yeah.
Go ahead, Dennis.
We can read it if we see it.
Yep, I'll read it to you. Everyone is promoting talk to us to save taxes on your retirement fund. Any comments or ideas on taxes on our 401k?
Well, I'm not sure I totally understand the question, but we'll give a little background. So, when you can have your money come out of your paycheck, and, I know WTMJ has the best 401k plan in the country. But,
Yeah, you are correct.
is that, if it comes out pre-tax and goes in, and the money that comes out, it came out of your paycheck pre-tax and begins to grow tax deferred, and oh, by the way, the company put free money in for you, that's a pretty good deal, right? The only question that he might be asking is, should you either do that along with a Roth, or not put it in, pay the taxes on it at this low interest rate, and let it grow on a tax deferred basis? They're interesting questions. It's not a black and white answer, but I would say for 90% of people, if not more, pre-tax dollars growing on a tax deferred basis when your company puts in free money for you is a pretty big deal. I would say most of the folks that come in here who haven't inherited the money or sold their business, their biggest chunk is in their retirement plan.
Yeah, I mean, Dave, a lot of us were I think talked into joining a 401k. Even for myself, we had a pension, but a lot of us wisely decided to also have a 401k. And as you retire, those are some substantial deposits that you're starting to have to make real decisions on as you're getting ready to make that retirement decision.
Steve, I don't know if I ever told you this story, but my dad worked at Ellis Chalmers in West Dallas for 44 years, right? And for those of you who remember, I know you were the mayor of Oak Creek, and there was some folks over there too. But in West Dallas, all those people paid, and had a pension, and then unfortunately, Ellis Chalmers failed, and they had to go what was called the PBGC, the Pension Benefit Guarantee Court, to get some pensions back, right? So that's a big reason why you see what's called defined contribution plans and less of defined benefit plans. Defined benefit plans is a pension. Defined contribution, think about 401k or 403b if you work for a school or a government agency.
Thanks to Dennis for that question. Bob Zimmer has a question.
Dennis, could I jump in here? I hit the wrong button earlier.
No problem.
My question was, it's a week doesn't go by now that somebody isn't on the phone trying to get you to go through your accounts with them, because they claim they've got ways to save tax on our 401k. I totally understand the interest, the reasoning behind 401ks, but they all claim they've got secrets to get around paying taxes and how we should be moving our money now.
Yeah, no, I'll tell you what they want is they want you to move your substantial amount of assets out of your 401k plan into an IRA that they get fees and commissions on for managing, one. Two, if they're going to try to save taxes, they want you to take that money, take it out and put it in a life insurance policy where they make a hell of a lot of money, or an annuity. So walk really, really slow with any one of those things. Be very skeptical. As I talk about, I was the chairman of the board of the certified financial planners, the CFPs, and I here in Wisconsin, and spent a lot of time. And there are some unscrupulous folks out there. So just be careful. Not saying that they're bad guys without knowing the whole story, Dennis, but if they have a motivation too, and that's the reason why fiduciaries are the better path.
Okay, I haven't even talked to them. That's how skeptical I was of them.
Yeah.
Figured the only thing to do is, depending on where your income was, if you're ever down a year, cash in a little bit and roll it into a Roth.
Yeah.
Pay the tax on some.
I'll tell you what, if you ever get anything from them, and tell them to send it to you in writing, and if you want me to take a look at it, just send it over and we'll look at it.
Okay.
Thank you, Dennis.
Yeah.
Bob Zimmer has a question on the income tax rate. Go ahead, Bob. I'll ask the question then for Bob. When do you expect that the income tax rate will go up?
Well, right now, I was shocked that President Biden did not talk about personal income taxes today. And as we talked about in the presentation, it's probably the second, I don't like that saying, kick at the gas. It's the second bite at the apple, right? And so, we had been told that those who make more than $400,000, that all of the Trump tax cuts would be taken out. That meant 37 going to 39.6. But more importantly, I was concerned about them taking income and capital gains and taking them up to income levels. So in other words, if you pay 20% capital gains, they're talking about taking it to 40 to 43%, doubling the capital gains. That would crush people's philosophies on investing in long-term capital assets, because not only because of growth, but because of what you're going to pay on it going forward. That is not a good idea. There is lots and lots of papers that have been written that people, because to get a capital gain, you have the choice personally to sell the asset. So you guess what are people going to do? They're not going to sell the asset, and they're going to wait till that guy gets thrown out of office. And so they can control when they get their capital gain, and they just won't do it. So there's lots of papers that have been written that say the actual revenue to the government goes down when the tax rate goes above a certain level, and that level historically has been around 28%.
Thanks for that question, Bob. Next up is Ty. Question on, well, he's got a very specific question. Go ahead, Ty.
Oh, well, I was just enjoying the call for number one, but for number two, I had earlier asked about the Russell and/or, trying to get more specific on, as you say, move more weight into equities in general terms. Some of my investor buddies who pay way too much money for a program called Socrates, they're saying there's going to be this May 8th 30% correction. So I'm curious if you or your place, how would you advise all of us on this call there will be some wrinkles up ahead. So do we pull into cash and wait for a deeper buying opportunity, or what do we do?
Yeah, so there is, and there has never been a binary decision, right? So in other words, trying to time the market means that you have to be right, not once, but twice. When to pull out and when to get back in. And so if you have a portfolio and you say, normally my risk tolerance suggests that I'm a 70-30 split, just to make an argument here. I think it's too expensive. I can take my asset allocation down to 60-40, 60% equities and 40% bonds. Now I have this dry powder in my 40% to go buy stocks when they get a more inexpensive or less expensive. So hey, take that money that's in fixed income and increase your fixed income position, so you have that dry powder if this Socrates fellow, if he's right about a certain date. But you know, Ty, there's just no way to know what's going to happen on a day-to-day basis. Never has someone said on a certain day is the market's going to correct or go up. Have they been right? And so
you're exactly correct, and you always give great advice. And I'm just sitting there, and early on in we'll call the COVID cycle here, I happen to jump into a ton of REITs. I'm not saying that's right for everybody, but I went after dividends and they all appreciated 20-30%. Now they're all topped out and they're coming back down, or they're going sideways. And so I guess I'm gonna have to set up an appointment with you fine folks, but thank you for tonight.
Yeah, you bet, Ty. So REITs, real estate investment trusts, everyone said they're dead in the water, right? Because you drove around and it looked like it was back in 07, 08 when everything was failing. Nobody was going to office. I gave Mr. Slitsky at Northwestern Mutual a big lot of love earlier on, but he built that $500 million building that looked like it belonged in Abu Dhabi, and it was empty. And so, but guess what? People are starting to go back to work, even though it may not be what it was. People will go back to the office. Maybe they'll take a day or 2 days to work from home, whatever the situation would be, but they're not abandoning all office space. So I think that REIT was a really nice play.
Thank you, Ty. Let's see. Tom has a question. This is something you and I have talked about a lot, Dave, on the show in the last year or so, is cryptocurrency. Tom, are you able to ask the question, or you want me to ask it? I'll take that as a affirmative that he wants me to ask it. What is your thought on adding crypto as a part of the overall mix to the portfolio, as many bigger players are adding it to their future pay and income mix?
Yeah, I'll tell you, the only reason why I haven't done it here, and we have over $4 billion, is because there's two things that are happening on our platforms, and we use TD, Schwab, and Fidelity. They just haven't opened that up yet to buy. You have to go to a certain currency space to go buy those things. And so, where we custody our assets, that's one, that it's not available to us. Number two, we strongly think that there's going to be some type of regulation and oversight by either the Federal Reserve or the SEC or somebody. And so those two things don't exist today. And so the argument against it has been that it is fraught with potential issues. One of them being you don't know who's on the other side. So we have a rule, it's called know the customer. And we have to know the customer. If someone comes to us and says, here's X dollars amount of Bitcoin, and we don't know who it is, we just can't do business with them. That's the problem. Now, if you are a client, Steve, and you're a client and you have assets with us and you say, I'd like to go buy some Bitcoin, there's ways to get that done. You can see, as the caller alluded to, Tesla says you can buy it, you can buy their cars now with Bitcoin. So if the downside is if you're a drug dealer, right, and you just sold a bunch of cocaine and now you want to buy a car, go ahead and buy it, and now you can sell your Tesla and you just washed that money. The good side is Bitcoin has gone, $50,000. It was, people have made an awful lot of money. We had a client who came in with a lot of money who bought it at 1,000, and they made a lot of profit.
Thanks for the question. Nate K is up next.
Yeah, has Annex changed the way they handle their positions based on the recent actions of Reddit or Robinhood?
Yeah, no, we watched it carefully. We, what we do with our clients and what advice we give doesn't mean that I can't go to Reddit and read it and be informed upon it. But we did get a message, a notice from the SEC that says they're watching it, and if you're going to make decisions based on that, you better have a heads up. So Nate, you can go look it up. If you are so inclined, you can go to the SEC and see that the notice that they put out talking about these sites and manipulation of some of these stock prices. But there's certainly people who've made a lot of money. There's no question. But I will tell you, I was deeply invested in the market in 98 and 99 and 2000. And those day traders who were buying Ferraris all ended up in tears and broke. So I'd walk carefully with that.
Great question, though. A couple more here before we go, Dave. Another Dave on inheritance tax. Dave, can you ask the question? I'll ask it. As we know, recent changes have happened. Do you see any additional changes that will occur with new administration spending packages? He said his audio is not working. That's why he couldn't ask the question. I think he's just talking about some of the things you mentioned during your presentation.
Yeah. So estate taxes. Well, first of all, will you remember Trump's estate tax change moved the amount up to 11.5, give or take some inflation numbers, 11.5 million per person. So $23 million without paying estate taxes. But part of that is that it would expire in 2025. So if anyone is fortunate enough to be in that category, you should move. You should move quickly because that is not going to be around forever. And I doubt that it's going to be renewed. Now, certainly the conversation we're hearing out of Congress is that they want to lower it. And Miss Warren, Senator Warren, wants to not only lower it from 11.5 down to 3.5, she wants to impose a wealth tax on top of it. So the estate planning is becoming really, really important. And so, yes, you got to look at it, but it's not. Now, when you talk about estate planning, Steve, we're not just talking about how much money you can give away. We're talking about everyday estate planning, and everyone on this call should have an estate plan. God forbid you get run over by the Miller truck. What happens with your money? What happens to your spouse? What happens to your kids? Who watches them? are all your agreements set up the way they're supposed to be? So everyone needs estate planning, even in the most basic of cases.
Yeah, that's something that's great advice, and something my wife and I just did recently as well. And not just leave it, do it and leave it. Take a look at it every once in a while to reevaluate if you need to.
Right.
I think so. Two more questions, Dave.
Right.
This is from IMS. If you want to ask the question, go ahead.
Yes, hi.
Hello.
With the new IRA rules that now you cannot, it's got to be gone in 10 years. I've got a nice chunk of change in my 401k and IRAs. I'm in the low tax bracket right now, and with interest rates being low, I'm wondering if it would be advisable to, in the next 2 years, put as much money as I can from my IRA to a Roth, since the interest rates are low. Is
That's a
that?
great question. Yeah, so that 10-year rule that you're talking about was for inherited IRAs. The money that you have in your IRA, did you earn that or did you inherit that?
I earned it
You earned it. Then
the
that's
hard way.
Yeah, hard way. You're right. You did ditching. I know that's a ditching. Dig in ditches. I know what that means. So that does not apply to you. That 10-year rule does not apply. That is for inherited assets, and so you can still keep your money in your IRA and your 401k. It's just that it used to be you have to take out at 70 and a half. Now it's 72. So there is no 10-year rule on that.
What about my husband's IRA? He's in the same position. So if I inherit his?
Right. You're not putting kerosene in his coffee, are you?
Well, your answer would depend.
Depends on what day of the week it is. I get it. So he is he's in the same position. He doesn't have to take it out, and there's spousal transfers. That big move is if you're going to give it to the kids, and the kids couldn't leave it in. If your kids, just as theoretically, because you sound like a very young woman, let's just say that they're 20 years old. I'm kidding, right? And they can't leave it in there for 40 years and not pay taxes on it. So it is that they want to get their they want to get their bite of the apple, and so they want to take it out. So now that's one part of the question. The second part of the question is, does it make sense to convert? There is a formula, and we have the spreadsheets to do that. If you want us to take it and do the work for you, we'll do that and say, this is what it's going to take for you to convert to make it make sense. Because remember, when you convert it, you have to take all of that money out and pay taxes on it at current income tax rates. So income taxes are going higher, interest rates likely going higher. So there is some argument to do it, but your facts and circumstances may be different than the next person.
Oh, okay, thank you very much.
You bet.
Great question. Great question. Let's see. Carol enthusiastically has her hand raised, so let's let Carol get a question in. Go ahead, Carol.
Well, that would be my wife. I'm Jeff, but my wonderful wife. Thanks for the program, guys.
Thank you.
So these asset bubbles with inflation, the uptick with inflation with all the Fed stimulus and the devaluation of the dollar, and with the stock market as high as it is, and with the stimulus, how do you think this is going to play out? Do you think there's going to be some unusual corrections in the near future?
Yeah, thanks, Jeff. I didn't get to that, but part of the answer of all of the debt is that people lose confidence in the system. That's number one. And part of the reason why you're seeing Bitcoin do what it's doing, because it's another form of currency. The second part of the question is, not only confidence, but the U.S. dollar is the world's currency, right? So if that begins to lose value, and the Germans and the French and the Russians and the Chinese stop buying, and thinking that the currency, U.S. currency, is less valuable, the dollar begins to decline, and that hurts companies that are here and sell abroad. I see Carol looking over here. She was the one that was fervently raising her hand. All right. So that was so that is an issue. There's no question about that, Jeff and Carol. That the dollar is a problem. So it depends on when you ask me. And if it's after 4 cocktails, what do I think can happen? Well, it's not good, right? Because at some point you've got to pay the pauper. And so how do we get out of it? One, the good answer is we grow out of it. The bad answer is we don't grow and debt exceeds and people say your US Treasury is garbage and interest rates go through the roof and inflation goes and then we have a problem.
Do you
So
think silver and gold are 5% positions is a good thing?
I do. I don't know why gold's stuck in the mud to use that expression. It's just not moving for whatever reason. It may move, but we look at it. And so what we have done is because remember, gold is a commodity. What does that mean? It doesn't have an income to measure and a price earnings to put on it. It's a commodity. How much is someone willing to pay for it? So what we've done is used gold miners, stocks, companies that have revenue and expenses and income that we can measure versus just the commodity. But like gold and silver as a commodity in a portfolio, 5 to 10% total position is not an inadvisable position.
Can we get into the market now? Like we've got some positions. I'll make this quick with, conservative. The bond thing was, we're close to 60. So we were weighted probably 15% in stock and 20% in stock and in the different buckets, kind of the same, depending on which money we're going to use for a state.
Yeah. You know what I would suggest, guys? I'll tell you what I'd suggest is just because there's 100 people on the call is that you go through the exercise of getting a portfolio review and we'll compare what you have to, based on your risk tolerance compared to what we suggest. If you want to go through that, we'll send that to you if that makes sense as a nice tool to help you with this conversation. I think that'd be more advisable than to try to give you advice without knowing everything that's happening.
Great.
Okay.
Thanks a lot.
You bet.
Yeah, thank you guys. Jeff D, I want to respect everybody's time. Jeff D has the final question of the night. Jeff, if you're ready, otherwise I can ask it. Well, Jeff, I'm going to ask it. So let's do this. The question is pretty simple. It's a prediction question. How healthy will Social Security be in 15 to 20 years?
Less healthy than it is today. So it is a situation where it's not going out. If no more revenue goes in, guys, to the system than is happening today, if there are no fixes to Social Security, the expectation is it doesn't go bust. It just can't pay its amount that it's supposed to pay out. So if you were supposed to get $2,000 a month, you may get $1,600 a month. That is if the politicians' heads are so far up there, that they do nothing at all, zero. And I doubt that that's going to happen. So, but that's the worst case scenario would be that there would be a deduction to the amount of support that comes out of Social Security. Remember, it's our money that they're giving back to us. But it would be traumatic for, my 92-year-old mother, for example, if she's expecting 2,000 and now she's getting 1,500, that would affect her lifestyle, right? And I'm using her as an example, even though that's not true, right? But it would hurt if it got deducted. I strongly think that there will be a fix. That one of the easiest fix, remember, there's revenues and there's expenses to Social Security. The easiest fix, guys, would be not to cap Social Security at its current level, but to raise the Social Security tax cap amount. So instead of whatever it is, 130, it goes to 250 or whatever the famous number of the day is. And that is a whole lot of revenue going into the system.
Thanks to everybody. This has been a great webinar. And I want to thank the expert, Dave Spano, who I don't just have him on the show because he's one of our partners at WTMJ. I have him on the show because I respect and appreciate his wisdom on these issues, and he is somebody that I always look forward to talking with on Mondays. So you can listen to him two ways. Mondays, self-promotion, Mondays at 10:35 along with Carol Kane, and then of course Saturdays, the big show, 10 o'clock, Money Talk, Dave Spano, Mark Oswald, tons of wisdom. I listen to it almost every Saturday. Please check that out. Dave, thank you so much.
I really want to thank you, Steve, and WTMJ and Kirsten for putting us all together, but more importantly, everyone who gave us an hour and 10 minutes this evening. So please enjoy. The sun is, the light is still, opportunity to still go walk the dog for a little bit. But if anyone needs any help, please reach out at annexwealth.com and we will be sure to answer your questions. So again, thank you and enjoy the evening.
Good evening, everybody. Thank you so much.
Did you unmute us? You didn't know how afterwards?
You know, it's crazy.
So